We're in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Jarad Madea, CEO of Howden Capital Markets Advisory. Jarad, it's good to have you with us again.
Richard, very much appreciate being here with you. Thank you very much.
So, Jarad, insurance and reinsurance have, broadly speaking, been bought in the same way for hundreds of years. To what extent could we be about to see a fundamental change in that?
It's a good question, and there's been talk probably for hundreds of years, bought and sold in the same way. There's been talk for decades on disintermediation and whether it's going direct on the primary side or reinsurance side and what is going to happen. And things have evolved and changed, but probably not as drastically as we've thought. In fact, I think even brokers still continue to gain share of the overall market, particularly in primary side, but also reinsurance side versus some direct players. I think the reason for that, the world continues to be a very risky place. When you think about potentially social inflation, think about climate change, think about the geopolitical situation around the globe and broadly, there's a lot of risk out there, some known, some unknown, and there is a lot of change. And when you're thinking about if you're a corporation managing that risk, you really need to talk to somebody, talk to an expert who can help you quantify and understand that risk. How do you manage that? And there's a lot of evolution in our system on the insurance side, and how do you most optimally place that risk? So there's a lot of change there. With all that said, there is a lot going on, and just with AI as a topic coming up, I'm nowhere near the expert as many of us in insurance probably aren't. But with that coming, I think there will be some more room for change, potentially more room to at least be more cost effective, or maybe think about risk or placing of risk a little bit differently. On the back end, on the reinsurance side, retro side, or ILS side, and cat bond side, I think there's probably a more easy area to attack in terms of how risk could be bought and sold, whether it's systematically traded in the future or other. And in fact, we already structure a few reinsurance contracts on our Howden Re side, really to have clauses to be able to trade those contracts in a secondary market. So there's evolution in moving that way, but just not fully there yet in terms of where we've been and how we've seen risk bought and sold over the last century or so.
So with all that in mind, the reinsurance cycle continues to turn, and some things that we might expect to see as that market turns, we perhaps haven't seen this time around. It's 20 years since the class of 2005. Right. We haven't seen their like again.
Right.
Why not?
It's a good question, and we obviously have seen capital coming into the reinsurance space. It's an attractive returns now, and I think it will continue to be that way for some time. But I think the speed of capital and how it can come into our system is a big reason. So before that capital, post big event, would come in balance sheet form. Now it can come in, yes, quickly, but it can also come in many different structures and formats. So you see a lot of capitals come in, post Hurricane Ian 2022, not in like a class of 05 formation, not like a class of 01 formation, but you see a lot of sidecars. You see a lot of capital coming in the cat bond space where the issuances outstanding are at all-time record high. You see investors coming in to play that current market in 1 to 2 year durations where they know where the rates are, they know where the risk is, they know where the opportunity is, but then it gives them a decision to potentially leave after a couple years versus being in a long-term balance sheet, for example, where you don't know where the cycle will be in 5 to 7 years. So I think that's one of the key reasons of why we've seen that, the innovation of some underlying capital and how it comes in and plays. That being said, we have seen for some management teams, we have had startups, right? Moreo, Oak, in the last year. There's a number of other good teams that have been able to get established and get off the ground, and if they find their niche. The other thing, if we do have a very large unknown event, similar to KRW 05 or 9/11, could there be another class? I think the answer is possibly, but I think it would need to be a very large event that is very game-changing of what the capitalization industry looks like today, not just take a dent out of the capital in the system, but a very large gap to maybe where we would see that again.
So here in Monte Carlo, inevitably looking forward to the January renewals. There's a lot of talk as to where we are in the reinsurance cycle. Firstly, I guess, do you have a sense as to where we are? But more importantly, perhaps, is what does that tell you about what happens next?
Yeah, I think a lot of the conversation here in Monte Carlo this year is that we're off of what was the peak. Pricing has started to come down, and that being said, at which I think we agree, I I think the important part is that the market is still at attractive levels. There's still attractive returns to be had for the primary insurers, for reinsurers, for ILS managers, for other end investors across the system. And I think that's very important. Even if the rates are coming down a bit, we're still at a very attractive, we think, rate opportunity for those end investors across the value chain. And I think that brings a few things. I think it brings more of the same, that we'll be able to continue seeing some of that creativity, innovation across the space with end investors coming in and having opportunity. I think the other thing that we typically see when rates are coming off is more M&A. That being said, if you just look at a broad public company index of insurance carriers today, they're probably trading at or near 10-year highs, right? So they have a good currency. They've built up excess profits and excess capital over the last few years. If they start to see their organic growth slowing a bit, they're going to be in a good position to want to and need to, frankly, acquire. Potential sellers, on the other hand, I think they'll see, okay, my growth prospects maybe aren't as strong as they were in a hardening market. When things start to get a little softer, maybe they become under some expense pressure. But I think we'll start to see and feel the need for M&A and more consolidation on both the carrier side. When I say the carrier side, both the buyers of the carrier side and sellers. So I think we're going to start to see a fair amount more carrier consolidation, whether that's acquisitions or true merger of equals or other. And in fact, over the last 6 months, we've been involved in 2 deals. One was the doctor's company in the med mal space acquisition, an announced acquisition, hasn't closed yet, of Pro Assurance. Another one announced last week was Skyward acquiring Apollo in the Lloyd's market. We represented Apollo in that transaction. And the other one, obviously, recently announced was Aspen's sale to Sampo. So we're starting to see some of those things. And again, it's a long-term cycle. Those deals don't just happen overnight. But I think where the cycle is going, some of those data points, we're going to see more consolidation here in the near term.
Jarad, one final question, if I may. What issues are we missing today that are going to be most important tomorrow?
That's a great question. I think there's a lot of talk of AI, and I think there will be, I think part of the interest in that is we don't know how it's going to play out. We don't know how it'll play out in terms of managing the expense side, maybe managing the loss side, or some other area that we don't even know about, right? Same with the risk side. We're always surprised when something new, or you have large wildfires in California. Obviously, we've known that's a risk, but sort of the size, extent of some of them. There's a lot of change coming from climate change. Again, as I mentioned earlier, just change around the geopolitical landscape, the social inflation. Within that, we all know there's risks, but there's just a lot of still unknowns that I think change again. But that being said, people can be worried about those, but I feel good that the industry is in a healthy place where you still have a lot of capital that could come in and that could creatively find solutions and innovate. And the industry's always done that over the decades, right? It changes a little bit how it gets done, it gets tweaked, it gets innovated. But the industry always seems to find a solution to provide the coverage for that the ultimate consumers need, which is great. And I think we're still in the same place and able to attack those challenges that we may not know what they are in the future.
Jarad, it's great to have you with us. Thank you very much indeed for your time.
Richard, I appreciate the opportunity. Thank you.
For Invest TV, I'm Richard Banks.